we meet in an hour of change and challenge, in a decade of hope and fear, in an age of both knowledge and ignorance. If this capsule history of our progress teaches us anything, it is that man in his quest for knowledge and progress is determined and cannot be deterred. Because that goal will serve to organize and measure the best of our energies and skills. Because that challenge is one that we're willing to accept, one we are unwilling to postpone, and one we intend to win.
Welcome to another episode of the Energy Impact Podcast. Our guest today is Ben Baker, the Managing Director at Greenbacker Capital. Ben, great to have you on the show.
Great to be on. Thanks for having me.
Yeah. So before we hear about all the amazing stuff that you're working on with Greenbacker, tell us a little bit about you. Where are you from?
Yeah, sure. Nothing too exotic. I'm from Connecticut. Grew up in Southern Connecticut, went to public school there, and moved to New York City 20 years ago to go to college. And I've been on this island pretty much ever sin's. So
I think some New Yorkers might say Southern Connecticut's exotic. You could get away without the disclaimer.
Yeah, I try.
And was finance sort of always the path? I mean, was that like from an early age you were, trading baseball cards, or what was the impetus?
No, I wouldn't say that. Although I think from an early age, I might have exhibited some glimmers of entrepreneurship. My parents tell me that I used to like pull weeds out of the ground when I was like 4 and put them in a frisbee and then go sell them to people who would buy them for like 25 cents. So maybe that's where it started. But no, actually growing up, I was really into languages, and I was like into Latin and French and German and stuff like that. And it wasn't until later in life that that I came around here to what you could say is finance.
Fascinating. Yeah, I'm very jealous. I am not good with languages, but I can do the math and science and STEM side. So is that what you went to school for language or language arts of some kind?
I did. I mean, I went to Columbia, and I was a liberal arts, major. It's a liberal arts school, and I studied French and I mean, I studied all the core stuff that they have you study, but there's no finance, there's no heavy math, anything like that. I think we had to take econ. Did a lot of French, did a lot of German, Italian, got to travel, got to study abroad. But, I do think that everything is a language system, whether it's math or business or whatever. All of that time spent learning different languages and learning different cultures was instructive in how you deal with people. And, now having kind of spent 15, 16 years coming through finance, now every day is just people and relating to people who are different from you, and understanding what they're saying, even though they probably say it in a way that's different, than you would say it. So even if I'm talking to a native English speaker, I think that those experiences of relating to different people, are helpful. And then, of course, we also talk to lots of non-native English speakers. So yeah, that's what I studied.
Interesting. Yeah, that's a great take, and it makes sense, right? We're all just figuring out different ways to communicate core concepts to each other.
Exactly.
Well, very cool. Okay, so how did that evolve? So you graduated with this liberal arts degree. You're like, hey, mom, I'm moving back into the basement, or like, what was the,
No, luckily, well, so based on the age that I am, we were all figuring out our lives in like 2006, right at the height of the economy, before things started cracking in 07 and 08. So with a decent diploma, they would hand you out an offer, and that was certainly a time where you started thinking, well, if I want to defer a true decision on what I'm going to do in my life, one thing that I could do now is banking, to get a sense of what goes on in the world and business and all that stuff. So that's what I and most of my cohort did coming out of school and kind of into the 06, 07 timeframe, using that as an entree into just figuring it out, over time.
Cool. Yeah, I mean, what a time to enter you saw a full market cycle in about 18 months, right?
I know, and I feel like we're back. It
Yeah.
definitely was old school to watch a bank failure or two over the last few days.
Yeah. Yeah. Even faster maybe than what it was in oh 07, oh
Totally.
08.
Yeah, I mean, I had friends that worked, at Lehman and Bear at that time, so definitely remember that time vividly. And certainly been an interesting time now over the past week or so.
Yeah. Well, yeah, before we get to some of the froth in the market today, let's talk about the froth in the market then. So you're in investment banking. Were you in energy or more of a general position?
Yeah, I mean that's kind of how all this happened. Is you end up life is pretty random, and so ever since '07, I've been in something touching power, metals and mining, real assets, that sort of thing. And that's how it started in banking. And so then in '08, '09, into 2010, while things were slow, I would say that real asset M&A and real asset development is pretty counter-cyclical or pretty insulated from broader macroeconomic trends, right? Like growth in population drives growth in electricity needs, retirements of old plants, lead to the build out of new ones. And we were also just 5 years or so into the deregulation of the power markets across the US. We were 2 or 3 years after a wave of big bankruptcies, with companies like Mirant and Reliant, and companies that folks today probably haven't even heard of necessarily. So it was a pretty exciting and fast moving time in power, and at that time I started working on M&A and project finance advisory for, gas plants, coal plants, gas utilities, eventually starting to see the odd wind farm or wind company. But it was definitely just getting into renewables. It was back when people were still naive enough to think that a national cap and trade system was going to happen and stuff like that. And also so early that folks were still doing the VHS Betamax kind of thing with solar photovoltaic and solar thermal, and not knowing like what the future of solar would hold at that time, which was pretty interesting. So we were like following parabolic troughs and power towers and all these technologies that did not turn out to be the future of renewables, but it was an interesting time.
Yeah. Well, and pre-shale gas, right? I mean, $10 an
Yeah,
MMBTU gas versus $3 an MMBTU gas is a big difference.
totally.
Well, yeah, okay. Well, very cool. You saw a lot of different things. How did that evolve into the next step? I mean, at some point, you said, okay, I've got all this, I've got all these tools. This is what I want to do with it. And what was that thing?
Yeah, so I had those tools, and kind of in the back of my mind was going back to business school, and having a bit more of a formal education. Since, like I said, I was a French major, I'd never even sat in a classroom in higher education with much, numbers going on in there. So I was like,
Did you find that gave you somewhat of an advantage? I mean, in a like thinking about an analyst pool where each of them probably had the same sort of econ or finance background, you probably saw things a little bit differently and uniquely that added value.
I don't know if that was a good thing back then. Over time, I think that's evolved to be helpful. Back
It
then,
was a
you know,
switch.
my yeah, my team makes fun of me that I basically do financial models with crayons because I'm definitely rusty, and back then I was just figuring it all out. So, but again, next to other liberal arts majors who didn't have a finance background, we were kind of in the same boat.
Yeah.
You could take econ for 4 years but not know how to use Excel. Um, but yeah, no, it was an interesting time.
Yeah.
But
Okay.
yeah,
Anyway, back to business
so I
school.
was like, yeah, so I was like, that's something that I think is interesting. But before I do that from banking, I'd like to have kind of a differentiating stop along the way and kind of get a view into something totally, totally different. And so this was in like 2010, 2010 or 11. I was like, I'm going to go work in kind of the wild west of solar, which was CNI sort of rooftop solar, in 2010, 11. And, I went and kind of saw inside of that world for a couple of years, and it was crazy, right? I mean, they had just come out with, in 2008, 9, the stimulus package that led to the cash grant. suddenly every roofing company in New Jersey was a solar company. So it was a pretty wild time. And I got to business school and I was like, oh man, I'm never doing renewables again. So I went, and I had a view to transition towards private equity at that time. And so I went to GE, to their energy investing business, both my internship and after business school. I was like, look, just one thing, please don't put me in the renewables group. They're like, all right, we hear you. So I went to the midstream oil and gas infrastructure side of the business, and was working on pipelines and gas utilities and all these things. And ultimately, what happened was in 2015 or so, all the commodity prices crashed, as you were alluding to before. And I was like, oh, I guess that's a sign. I got to go back to the dark side, and have basically been in renewables ever since then. But the good thing, as we'll talk about when we talk about what we're doing now, is that I took a lot of the oil and gas infrastructure financing structures and investment structures and brought them here to what we do today, because I think that what we'll talk about is that a lot of the financing structures that are being used, especially for like early stage companies, but also for some of the assets, might not be the right financing structures. And so we bring some of those things from the oil and gas market as well.
Yeah, fascinating and interesting, maybe counterintuitive, because in my mind, and I've got a little bit of an econ background, I hear price drop. Well, that would be a tailwind for the industry. But what you're really saying is sort of living through that cycle is personally exhausting, and I can attest to
Yeah,
that as
no,
well.
totally. No, it was a rough time in that market, and yeah, I don't know. I think at that moment I was like, all right, maybe I got to give renewables another chance. And ultimately, when I left GE, I went to a private equity fund called Hudson Clean Energy, that was totally focused on clean energy, where I also learned, a ton. So that's how that progressed, and at Hudson, we spent a lot of time working with developers, growth stage businesses, in both kind of climate tech as well as just traditional renewable energy development and operations. And it was really there. It was a very formative time. But I think after my time there, what I realized was that if I wanted to keep investing in developers and partnering with them, I had to actually understand that business from the inside. And so that was a point, like I said, maybe 2017, where I said, okay, I'm going to go and work in development for a period of time so that I understand the nuts and bolts of this business. And so that's what I went and did. And so prior to my role at Greenbacker, I joined about 3 years ago to launch the funds that we manage. But prior to my time here, I was on the management team of a solar developer. We were developing greenfield solar farms from scratch, kind of all throughout New York State, as far north as Canada and as far west as Buffalo. And it was just really informative and really instructive to see how the dirty work of development actually gets polished over time and becomes these investable assets, that institutional investors, want to invest into and then kind of enjoy the cash flows for many years to come. But by the time they're doing that, years, months or years of work has gone into, just all kinds of stuff from chasing down landowners for a signature because they don't use email, to sitting in front of permitting boards in a small town on a Tuesday night, and they got their pitchforks, and they don't know why someone from New York City is trying to build something in their town, and what are you going to take from them, and so it's really interesting to see the different stakeholders and how you have to deal with them, because it's not just the ivory tower kind of work of finance.
Yeah, it's certainly unique to have advisory, direct investing, and operating experience. And yeah, the development world is wild, and it's so underappreciated, I think, in the broader energy transition space itself, right? Like,
Totally. Well, it's coming to be appreciated, but I think when we were launching this strategy 3 years ago, it was definitely underappreciated. So we'll talk about some of the trends that we've seen, but I think we were fairly prescient in the sense that we started investing in sort of growth stage developers just before a major wave of developer M&A both at the sort of large cap scale and now just kind of coming down into the lower middle market where we play.
Yeah, no, that makes a lot of sense. Well, yeah, perfect timing. Let's hit that transition. So you got your hands dirty for 2 years, and yeah, tell us about the move to Greenbacker and kind of what you're building.
Yeah, sure. I mean, I've known about Greenbacker, for a number of years, and what I've always liked about the firm is their approach to working directly with sort of regional and smaller businesses that are in the business of developing sustainable infrastructure. Because what we try to explain to folks, who invest in the fund or who come work here, is that there's billions of dollars being raised into the sustainable infrastructure space and renewable energy. It's every year it's setting a new record, for just how many dollars are being raised, right? But also those dollars tend to be pretty concentrated among the biggest GPs, the biggest fund managers, and folks that were, funds that were raising $1 billion fund 4 or 5 years ago are raising like a 5 billion or a 17 billion or a $20 billion fund. And when they're raising funds that big, their equity checks that they're looking to deploy are also growing in tandem. And that's sort of in contrast to sort of two things. One, that when you're finally, like I said, investing into a 300 megawatt wind farm or solar farm or what have you, that thing has been in the works for 2 years or 3 years or 4 years. And for many of those years, it was costing, hundreds of thousands of dollars or tens of thousands of dollars a year. And, eventually that starts getting capital intensive. But for a number of years, it's a pretty small business going around and cobbling together land options and dealing with the utility and the local permitting authorities, right? So there's all this money looking to invest into what is eventually going to be a big thing. But today it's small and today it's not capital intensive. So who's going to be the one to help bring those things and scale them to be investment opportunities for those bigger funds, right? That's one piece. And then the other dynamic too is that while the funds are getting bigger, while the checks are getting bigger, in many cases, the assets are getting smaller, right? I mean, distributed generation is something that we see as, both in GDAV as well as the broader firm. We've always focused on distributed generation. We think it's efficient. We think that it avoids a lot of the issues we're seeing in, in the interconnection queues and in the permitting issues that bigger projects might have. And some of the things that we've done, I'll just call out a really interesting one because it's kind of the logical extreme of distributed generation. We invested into a company called Swell Energy last year, and we co-led that round with SoftBank. And what this company does, the physical thing that it does is not innovative, right? They are going and originating and installing residential batteries, right? Or batteries and solar. But they're coming and saying, look, we're going to put a Tesla Powerwall on your garage, right? That is a well understood physical thing. But what they're also doing, their other customer, not the people, are the utilities. They're working with utilities to say, look, if we can enter into a large capacity contract, we can then go aggregate thousands of residential batteries and then use a software layer to turn it into one big thing so that when you need to call on it, it's there for resiliency, for capacity, for energy. And so that's taking the tiniest kind of nodal, little distributed generation thing and bringing it together to be something bigger. And that's something we really like. And as we look out into kind of the future of the same theme, which again, this is the virtual power plant concept, which is now getting a lot more attention. And I'm seeing the term, being thrown around a lot more now. But then you look at vehicle to grid stuff too, which is one of the next things coming. Like all of these EVs are power plants. You're getting like 2 or 3 free power walls laying flat on the bottom of your Tesla. That thing can power your house. So there's a few companies that we know working in that space. So again, this is not the majority of what we do, but it's just an interesting example of what distributed generation is coming to mean, at the logical extreme, and how different that is than anything that can be invested by a $10 billion fund.
Yeah. I mean, in some ways, it's a continuation of some of the demand response aggregators from PJM in the mid-teens, right? And that software layer certainly changes the calculus. So I struggle a little bit. I don't want to actually go too far down this rabbit hole, but I struggle a little bit with like batteries, equating batteries to power generation, because they obviously like they're actually energy destroyers, right? Now, the time arbitrage, super important, the distributed nature, a ton of value. But I do think there is like this fundamental thing that virtual power plants sort of skip over, which it works when there's excess supply, but if we're going to get rid of what's providing 80% of our power, like we still need to fill that gap in, right?
Totally. No, I'm with you, and we don't. I wouldn't say that we view batteries as power plants. Notwithstanding the term virtual power plants that I just threw out there.
Coming back to your language background.
Exactly. We have when we explain our fund to folks, we have a couple different buckets, but one of those buckets that we invest into is renewable energy generation, right? Inside of that is solar, hydro, maybe biomass, things like that. Batteries are not in that bucket, right? We have a middle bucket that's called mobility and grid services, and that's where batteries are. So yeah. We see batteries as a grid service. And so I'll give you, one general example is that something that utilities use batteries for is to defer transmission and distribution spending, right? So batteries can make your system more resilient and make them more adaptable, but without saying like, oh, they're generating electrons. It's not really about that, right? And so one of our businesses that's doing really, really well is a company called DeLorean Power. This company works with co-op and muni utilities, and these co-op and muni utilities, they don't own their wires, so they're renting them from a bigger RTO or utility, and they pay for RTO, their wires.
Regional transmission operator, right? So,
yep. And so they're paying a demand charge based on their peak demand, right? And their peak demand is going to happen at like 13 different periods, throughout a few months of the year. Yep. And so one of the main revenue models that our company works on is partnering with these kinds of utilities to install batteries where they can be most valuable in reducing that demand at exactly those moments, so that when you end up tallying their bill, they're shaving a large amount off their peak demand, saving money, and then sharing those savings with our company. So again, it has nothing to do with generating electrons or arbitrage, time of use arbitrage or anything. It's about reducing demand, which then for the bigger utility who owns the wires, has more resiliency in their system, has more slack in their system. So I think we're seeing it the same way.
Yeah, no, that makes a lot of sense. Yeah, tell us more about these categories. You mentioned two, but it seemed to allude that there were others. I think that's fascinating. Kind of walk through.
Yeah, and there's only one more, which is kind of the other bucket. But the other bucket, I think, spans a list of things from what we do expect to do to things we don't expect to do, right? So there's a whole host of newer looking technologies, or at least things that we don't know how to invest into yet, like hydrogen and ammonia, like carbon capture, things like that. Whereas there's also a part of the waste to value world, RNG and landfill gas and anaerobic digestion that has been around for a while that we think is an opportunity, and where I think private equity is starting to focus more and more. So again, the other bucket goes from things I do think are within reach to things that are a bit farther afield. But it contains all of the things that we think we need to be smart about, so that, maybe it's GDEV 3 or GDEV 4 when we do our first hydrogen investment, but at least we start getting smart today. And one thing that I remind my team and other people with respect to these newer technologies is I just have a vivid memory that it was 2016 when we really started talking about batteries all the time, and where I was at Hudson at the time, trying to develop a thesis to invest into the battery storage market. That was 2016. The first time I did a battery storage deal was 2021. So at least, I'm probably biased, but based on my tiny data set, there's a 5-year spread between really the year that you start talking about something and the year that you might do it. And I feel like hydrogen that year was maybe last year or this year, right? So I still think for us, there's some time. And that's just one example, but it doesn't mean we don't get smart now.
Yeah. Yeah. And there's maybe some corollaries between those two specific examples, in that what you think the market is on its surface, it may not actually be the market when you get to that investment point, right? To your description around batteries as a grid service, you wouldn't have thought that. Maybe you did. Maybe you were like so
No,
far
I don't
ahead.
think I
But
did.
in
I don't think I
2016,
did.
you're thinking
No,
about time arb, right? Time of use
totally.
arbitrage, and I think hydrogen's the same way. Like I think there's just some fundamental flaws in this idea of using electricity to create hydrogen to create electricity. But there's obviously some uses around energy intensive businesses and sort of high heat points. I'm on the fence about ammonia, but we don't have to get too deep. You're ahead of me for sure on that, and I don't know what you're saying.
No, I'm probably with you. I think I still have to be convinced on green hydrogen because I'm still trying to understand if I had a gas plant that was the most efficient combined cycle in America and that thing were creating the energy, to break apart the molecules, like is that not as good? Is that not pretty good? Is that not clean? I don't know.
Yeah,
So
yeah.
I'm pretty ignorant on the topic. I have to admit. One of the ways that I explain what we do is that we're trying to innovate on business models and not the physical thing. And so the virtual power plant example I gave you is a good one because putting a Tesla power wall on your garage is not a new physical thing; it's a new business model that these guys are doing. Community solar is a really good example, and probably the easiest one that the business that I was involved in prior to Greenbacker, which was called Delaware River Solar, we were doing all community solar. And this is like 2018, 2019, 2020. That was way before you start seeing these big, like Partners Group doing Dimension and Apollo doing Summit Ridge and ECP doing Pivot. That was years later, right? And so in 2020, when we were making some of our first investments, we felt that community solar, while it wasn't a new physical thing, it's just a 5 megawatt solar farm. It was a business model that we didn't think was understood at that time, but we thought would be very well understood and kind of the way that things would be going a few years later, and that has sort of played out. So I think community solar is a good example of how we try to innovate.
Yeah, no, that's fascinating and makes all the sense in the world, right? I think we have a lot of the technologies that we need. It's applying some of these previous business models to those applications.
Exactly.
We sort of skipped over it. You mentioned some of the different funds. What can you tell us about sort of creating these theses, right? Like you sort of started the investment arm of Greenbacker, I think.
Well, just to give some background on Greenbacker, to make sure it's clear, the firm has been around since 2011 and has been very successful, for over a decade of creating really an amazing reputation in sort of the middle market of US renewables. The flagship fund here, which has raised a couple $1 billion, is a sustainable infrastructure fund. So the broader firm, you could almost think about it now as a big power company, right? It's a firm that owns, that's structured as a company that owns, 3 or 4 gigawatts of renewable capacity, that has 185 people across 4 offices, and just an amazing technical ability to buy, construct, then own and operate renewable energy and sustainable infrastructure facilities. So that's really the backdrop that I came into. And so when I joined, it was to launch, our growth equity strategy, which again is now we're making under GDEV corporate investments into, developers and operators of sustainable infrastructure. But the broader firm is a big part of that story and really synergistic with us as well, right? I mean, we have different forms of capital in-house, right? For our companies, we have 50 or 60 engineering and technical folks that we can call on to help us, when we diligence transactions and when our portfolio companies need support. So we try to bring all of that to bear to be a bit more of a strategic investor than just financial. So I know that's a little bit of an advertisement there, but that is
That's okay.
That's why it was so attractive for me to come help launch a growth equity strategy against that backdrop.
Yeah, really interesting. Okay, I don't know why I thought it was more advisory versus infra fund, but that makes a lot of sense. And they are probably seeing a lot of the same themes you just articulated around check size and fund size versus capital needs. Okay, so So you joined the team. Were they already raising? Like, did they have LPs that were like, hey, we want to do this? Or you came in with a blank sheet of paper and built it up?
Blank
Yeah.
sheet in the middle of COVID lockdown. So that was an interesting and fun time. It was a blessing and a curse probably, because at that time, 2020 into 21, because road shows weren't physical, you could get a lot more meetings in, but you also can't create that personal connection, which
Yeah.
which I'd much rather have fewer meetings in person and get to look somebody in the eye and shake their hand. But yeah, it was a complete blank slate. And what we were trying to figure out was, because again, the firm's historical capital raising strategy was actually retail, right? So in the infrastructure fund, that's a retail fund with thousands and thousands of individual investors. It's very different from the institutional nature of the growth equity strategy, which is more more tailored to institutional capital. And so our biggest investors are pension funds and that sort of thing, insurance companies and the like. But at that time, it was a blank slate. And so we had to go and sort of think about, how do you get this thing off the ground? Who can be your partners? What is that mix of getting some early deals done to show that you can get deals done, to get capital in the door so that you can do more deals? It's a hard cycle to get on, and thankfully after 3 years of being at it, we're kind of, I think, more now in the groove. And but it was an interesting time
Yeah.
to be starting for sure. But the good thing was, there's enough folks out there who, when they really listen, they understand the story. And that's what it takes, is just a couple of those to really get it. And so we're pleased that we found those people, through 2021. But I think the story is good, because we were starting to invest in these developers, like I said, just at the end of 2020. And then when you started to see 21 into 22, just this page we have in our deck of like the dozens of major developer announcements, big funds taking over these developers. And where it started was the biggest national developers, the Cypress Creeks of the world, the Apex Energies of the world. But over time, as every one of those, previously independent companies has now become backed, the search goes lower and lower, into kind of smaller enterprise values, down towards not necessarily where we enter our investments, but certainly where we're trying to exit them.
Yeah.
And so we're really seeing the path there, and we're seeing the demand, I think, for the platforms that we're scaling now.
Yeah, it's your traditional PE story, but instead of a EBITDA multiple, it's like a pipeline. It's like capacity multiple arb, right?
Well, you nailed it. I mean, a lot of our companies are pre-EBITDA and pre-revenue, but sorry, I'll say they're almost all pre-EBITDA. Many are pre-revenue, but they're not pre-value creation.
Yeah.
And that's the story you've had to tell. People say, well, what is your entry multiple? We're like, well, it's divided by 0. Like, but they have 242 megawatts of pipeline.
Yeah.
And here's the deep diligence we did on the unit economics of it and the permitting status of those assets. That's the value. And, so that is what we're investing into. You're absolutely right.
Yeah. Fascinating. Well, very cool. We went really deep. I appreciate all of that color. I didn't give you a lot of time on sort of what you're looking at in the future. I guess we talked a little bit with your other bucket. But yeah, how does sort of Greenbacker, what did you call it? GDev?
GDev, yeah.
Yeah. How does this growth bucket grow over time? More funds, larger funds, different pockets? What are you thinking?
Yeah, it's interesting. I think we don't aim to be a mega fund, right? I mean, we want to stay pretty true to what we've set out to do, which is invest in the middle market and lower middle market, and really scale growth stage companies into being an attractive target for much bigger funds than us. So I don't see us, having multi-billion-dollar funds. Then again, I say that now, but that is,
it's hard to maintain that discipline.
Yeah, but I do think, when we think about the size of new funds, we think about like, how many deals do we want to do a year? What is the right size of those deals, right? And we kind of do it from the bottom up, rather than saying, well, we want this much AUM to generate this much fees. We try to stay out of that game, and it ends up aligning us nicely with our investors, because they know how important like the incentive economics are to us, because we're smaller funds. And so that has played well. I think the future is not necessarily much bigger deals. Certainly we've grown the team over the years to account for the growing size of the portfolio and all that. But I think we'll try to stay true to it, because what we see is just a constant regeneration of our pipeline. Because as every company gets really, really big, the management teams or the senior folks at that company say, well, I want to go do this for myself. And then they go and they restart the whole cycle. And we find them when they're a couple years in, they've scraped together a couple $1 million of seed capital. They've built a pipeline. And what started as a really capital light business is about to be really capital intensive because they did a good job. And that's where we find them. And so whether it's solar or hydro or batteries, or whatever in the future, the kind of stage of our business is and kind of the quality of the people are constant, across them.
Yeah. And it's a great point about the people and the, again, it is like a clear corollary with other businesses. Some people are really good at growth. Some people are really good at seed. Some people are really, right. I mean, and those people generally know that and like that aspect of it, right? Because I've seen folks that should be on their own or like are that developer mindset, and they get in a big system and it's like, cats and dogs.
Totally.
Yeah, that's fascinating. Well, very cool. What have we not talked about that we should have talked about?
Honestly, I mean, if the question is sort of where are things headed, I'll just say like two trends, that I see happening. One, solar is becoming very well understood, right? And that also makes solar assets very expensive because they've become a fixed income product. It makes investing into solar companies harder too, because there's a lot of interest in a simple solar company. But it also makes a solar company harder to differentiate its offering to its customers. So I think what we're seeing is good for both us and the industry, in the sense that more and more companies are going to broaden their offerings so that, you might not have a solar developer, but you have someone who comes and offers a more holistic sort of package that might include EV charging and batteries and solar and, and other things. And that will help differentiate those businesses. It will help complicate them, which we think is good, right? Because that's for some a barrier to entry that we think protects our ability to invest into the most complex businesses. So I think things are going to get more complex, because the simpler you are, the harder it's going to be to differentiate. And then the other trend, that we like, and the virtual power plant one was a good example of this too, is we don't really invest in software companies. Like we're not a tech investor in that sense, but we do see more and more companies who use software as a way to enhance and enable the physical offering that they're bringing, right? So I think that's something where the more complicated this stuff gets, and the more you have to optimize it, whether it's batteries or EV charging and fleets and all that, the more it's going to require some kind of technology and software layer. But again, what we look for is a company that's using a software layer to enable the physical thing, rather than building the software layer for that as the end.
Yeah. I think that narrative is certainly becoming a little more prevalent, because in this space you don't have anything without hardware, but you also want to optimize the operations with software. Yeah, no, that is really cool. I could see you kind of creating another bucket, right, of sort of software enablement as its sort of standalone category, and then creating some value with connecting your existing platforms given the operational focus.
Which is, I mean, you're definitely hearing the story. I love it, because what we're trying to do here is create an ecosystem so that, growth stage, renewables or sustainable infrastructure businesses come, and there's growth capital, there's technical support, there's infrastructure capital, there's this, there's that. So you're right that like the more we can expand this ecosystem over time, the stronger we'll get. And the ways in which we do that, I think some are still are unknown.
Yeah. Amazing. Yeah. Can't wait to see how you do it. And excited to watch that all come together.
Awesome.
Thanks so much for being on.
Yeah. Thanks for having me.
Our leadership in science and industry, our hopes for peace and security, our obligations to ourselves as well as others, all require us to make this effort, to solve these mysteries, to solve them for the good of all men and for the progress of all people.